Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Tuesday edition. We have one more show this week, so for those who might be joining us brand new, I will not be doing a show Thursday or Friday because I will be in the city of sin. I won't be doing much sinning, but I will be in the city of sin. Well, you never know. I could do a little bit of Sin City this morning. This weekend. Anyway, as usual, these shows are driven by viewer comments, questions, feedback, and again, I have so much coming in from you guys. Thank you very much. Ed up in San Jose, thank you for the information about the moon and lunar pole. He actually pointed something out rather interesting the other day. I was talking about how it just seems like recently I was of the understanding that the surface of the moon that we see doesn't move, and I made a comment because I'm thinking so quickly here, and I said it without thinking, which was, oh, well, the dark side of the moon is always dark, and that is totally untrue. Obviously, we're rotating, and the moon's rotating around us, so at some point, the back side of the moon that we can't see will be fully illuminated. The interesting part there is, that he pointed out that I did not know, is it actually receives more sunlight than the side that we see. And you would think it'd be 50-50, but because the Earth blocks the moon at times, therefore, we see more, the back side of the moon could see more sunlight. Anyway, so let's go into today's topic, which is the S&P 500 up another 10% this year. Not talking about total, I'm talking about from today. And the reason I decided to go with this topic is it was from a viewer. And Karen said, I saw a big analyst forecast the S&P 500 moving up another 10% this year. What are your thoughts? Well, obviously I have my opinions on this, and what I'll do is I will just kind of start a poll here to see what you guys think. Of course, I have to type. So I have to talk as I type, otherwise I will never finish this thing. The S&P 500 and P50 be up another 10% from here, from current levels, right? And I'll just put, there's your poll. So you don't have to answer right away. Some of you right away know your answer, and you're sure of it. Harrison says, once an analyst forecasted, it's guaranteed not to come true. Yeah. Well, the problem, Harrison, is you have one analyst saying it's going to be up 10%, and then another one says it's going to be down 10%, right? So analysts are like the specific body parts. We all have one. And, just the fact that an analyst says something, Karen, I like that you asked me the question because I'm going to answer your question the way I would answer it for any analyst recommendation. If an analyst says that he thinks that, XYZ is going to do A, B, and C, great. Good for them. Do your research. DYOR. So I didn't have a lot of time to prepare today, but I made a table, and I put in here all the things that I feel are good to make that statement of the S&P 500 going to be up another 10% from here. So first off, let's look at where the S&P is right now, and I'll just measure off a line so we can understand where exactly 10% would take us to, all right? So 10%, if you go exactly number to number here, I'm ever so close. I'll call it 6,580, right? 6,580, which would be another 600 points above where we are today. Not bad. 6,500. I think some of you actually had forecasted that as a target for this year, long before this analyst for whatever firm you're talking about here, Karen. We have more astute viewers here than some of these big financial firms. The sad part is you guys being here on this program, you're not getting paid anything, where that analyst, I'm sure, is being paid a significant amount of money for his thoughts and opinions about where the S&P will be. I thought I would bring this up here just so we could see it real quick. A few of you are actually over 6,500. Goodness, a lot of you actually are up over 6,500. Let's see, how many people put in their forecast? Out of the 70 people that put in their forecast, we have 28 actually think it's going to be up over 6,500 this year. Wow, pretty impressive. Anyway, let's go and break down the facts as we see them. And here's my variables. Again, let's start with just these. We'll run through these, and then as we see fit, maybe some of you guys can have something else that comes to mind, because I did this very quickly, and certainly it's not just these 6 or 7 things. There's many factors that are going to cause this market to move higher, but I put them kind of as they popped into my head today. So the factors that are going to drive this S&P moving up higher and getting to all-time highs, getting above 6,500, in my opinion, has to go through these pieces. And I know we've got a lot of podcasters here that can't see this, so I'm going to read them off one by one. So far on this list, and we'll do them one by one, I've got inflation, unemployment, tariffs, the spending bill, the trade war, and I have two for interest rates. I have long-term interest rates and short-term interest rates. So I'll start with the inflation side of things. As we've noticed through the most recent data that's been coming out from CPI, PPI, and from the core PCE price index we had last week, there's been an abrupt change in the rate of inflation. Now, if you go back to the beginning of this year, I always admit when I was wrong, and actually I don't think I was wrong at the time that announcement came out. I had talked about how if this trend continues with the inflation numbers, then I think we're going to go much higher this year. So here is the CPI number, or core PCE price index, that came out last Friday. Here's the chart for you, and you guys can see, well, everybody except the podcaster, sorry about that, but we've been pretty elevated on inflation really since 2021, 2022, and even if we go back a little bit further, let's scrolling way back here, I'm showing a chart right now that shows the core PCE price index numbers going all the way back into 2008, and I think we'd all agree that it looks like the average, if you go back and forget the 2021 surge, but just the average between 2008 and 2020 looks to be in between 0.1% on the CPI, core PCE, and 0.2. We had a couple spikes above, a couple below, but it looks to be, if I had to give it an average, it'd be like 0.15, right? Somewhere in there. So that's kind of what I would benchmark my normal off of. And now if we fast forward to where we are today, we are currently back at those norms, those levels where the Fed inflation was never really a discussion back then. It wasn't a topic of discussion. Well, what kind of made me uncomfortable at the beginning of this year was how we were above 0.2, and then we started to see it surge in December, January, February, March, into March. It kept surging higher and higher and higher. And you guys know me, I'm a trend is your friend till the bend at the end. If that trend had continued, then inflation would be a monster problem for the S&P to get above another 10% this year. There was no way it would happen if inflation kept rallying like this. Now, the question is, do these recent two pieces of inflationary data, the core PCE price index for April was showing 0, meaning no inflation, and the most recent one we had last Friday showing 0.1% inflation increase, is that one-off data? Is this still that shock factor and the market's trying to adjust to the tariff issue, all of that? Or is this, in fact, the new inflationary data? I don't know 100%. The more that this stays down here, the next reading, of course, will be at the end of this month, it will give me more confidence that these numbers are actually, staying low, as opposed to just kind of a knee-jerk reaction where things shot down and then they're going to spring back up. Typically, when you throw a large rock in a still pond, and I would argue that if you look at the U.S. economy, not that it was a still pond, but it was a creek that was running along and doing okay. Not great, but okay. And you throw a big boulder in, what happens? Well, the water gets depressed, and all of a sudden you get a splash up, and then it goes back again. That's normally what should happen under a situation that Trump has put us in, which is shock and awe, and big tariff, no tariff, inflation, deflation. It should have those ripples. So I'm not sold yet that inflation is controlled, but it does look a lot better than I was expecting it because of the contraction here. Now, if I put that as a factor for the S&P 500 moving up this year, it's tough for me to say. I would actually lean on the side right now of the current inflationary data would support another 10% rally in the markets. And the main reason for that is if inflation stays low like this, the discussion in June, July, August, September, the rest of this year will be more and more pressure on Jerome Powell, which we've talked about, right, to push rates even lower. That happens, then you'll probably get, Chad says, isn't deflation a risk to our system? Yes, but we're not there. I mean, granted, you're totally right, Chad. It is, but if you look at this, when's the last time we had deflation? We had 2 months of deflationary price on the core PCE price index back in 2020. Other than that, I mean, we have to go all the way back out to 1 month in May of 2017. Other than that, I got nothing. So, yes, it would be, but it's such an anomaly outlier at this point. I'm not that worried about it. And to be fair, Chad, this market could dynamically shift, and all of a sudden we do find ourselves in a deflationary environment. And how would that impact our markets? Because to me, if you look at a bell curve, I would say that possibility is kind of way out there. So I'm not putting that into my analysis yet. And Granted, this is my analysis. Your analysis might look at that and say, hey, I think we're going into a deflationary environment. Therefore, I think that that's going to hurt the economy. And that's fine. We all have to come up with ways to analyze these markets. For me right now, I don't think that that's going to happen. But, as we know, anything can happen. So I'm going to write on the screen here. We'll go to kind of do this live as we go. I'm going to put that inflation supports upside move. Okay, just to kind of have that there as a 1 point, just because I do think as the markets continue to show strength and the CPI, core PCE, CPI numbers all come out lower than expected or staying underneath 0.2%, then that means they'll probably juice the markets even more. Okay, I've obviously spurred some discussion here. What does FundStrats Tom Lee say? I don't know, but by the way, you guys know John Rowland. He does the market on close for bar chart. I believe Tom Lee will be on his show this Friday. Pretty cool. That's what happens when you have a team, right? He's got a team of people going out and getting good guests for him. So that should be a pretty exciting one if you guys want to see that. Let's see. Tom Lee says 6,600 by January 1st. That would be right in line. And I don't know who this analyst is that Karen's referencing. Doesn't really matter. I guess it's just the discussion of do we get a 10% rally. Steve says if Trump gets the trade deal signed, that probably takes a few of those roadblocks off. We're not there yet. Hold on, Steven. Don't jump. Look at our list. We got to go in order here. Steven, the impatient child, raising his hand. Let's do this. All right. So let's stay on this list here. What did else you say? It's funny. Everything's still expensive. It's just not getting more expensive. Right. That is the irony of inflation. And the most recent core PC price index numbers, while they sounded so great, that just means that prices aren't getting more expensive. I mean, I would love it if things dropped. And I have to say, this is probably one of the biggest, fastest inflationary surges I've seen since I've been paying attention to markets. Why would you cut rates if inflation is under control? Because you want to juice the economy. You want to keep things looking good. And the pressure to do so will be growing and growing. Because the argument will be, why not? Why not cut rates and help grow the economy? If inflation's under control and unemployment is great, which will, well, let's get to unemployment. I'll answer that one, Naum. And by the way, congratulations, Grandpa Naum here today. Cutie. If we look at the unemployment rate, obviously these first two are the dual mandates of the Fed, right? Inflation is stable pricing. Unemployment is making sure Americans have jobs. The JOLTS job openings number that came out yesterday was great, right? Certainly showed we have plenty of jobs. For those who might not know what I'm talking about, let me show you. Actually, the JOLTS job number came out today. Let's look at this chart here, okay? Would you guys say this chart that I have on my screen right now looks good or bad? Would you say that chart looks good or bad? Because at first glance, I think we all would have this impulse to say something about this specific price chart here. Now, this is the JOLTS job openings. What this represents is job openings in the U.S. Like, how many jobs are there right now? Okay, what do you guys think? Good or bad? Nobody? VB Met says unemployment will surge in Q3, Q4. I tend to agree with you. All right, Steven says this chart looks bad, right? And I'll be honest, Steven, when I first looked at this, I went, ooh, this looks really bad. And what I'm not showing you is I'm not showing you the whole picture. This is why it's so important to look at the big picture. Watch this. Let's scroll over here. Right now, the chart I'm showing you just goes back to 2017. And yes, you would look at the trend, as Dwight says, and less, bad trend here. Yeah, we were in May of 2022 at 11.55 million jobs in America. 11.55 million, that's great. And now we're at 7.39. This looks atrocious. It looks really bad. But when we zoom out, I'm now showing you all the way back to 2005. Now look at it, right? It tells a different story. We're coming back to kind of the long-term trend here. 7.39 million jobs is higher than anything in the history of the United States economy prior to 2019, right? 2019, we'd never seen that kind of job creation. We had a huge surge here, probably COVID-induced, right? All kinds of free money out there and people spending and expanding. We saw the stock markets reflect this. And now you have it returning back down. So on one hand, it looks bad because it's trending down. But the long-term trend says we're actually doing really good. Yes, it's lower than it was a year ago, but it's still long-term actually a pretty darn good number here, okay? So I would argue that the unemployment numbers, which is a big factor, JOLTS job openings is just one point of that data. The second piece comes out this Friday, which I will not be able to go over with you because I will be in Vegas. But, we've kind of flatlined here. The chart here does not look that bad, especially if I start big picture. This is the unemployment rate going all the way back into 2005 again. We are historically very, 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 very low. Right? The only times we were lower were for a few months back in late 2019, we spent most of the year below that. 2018 as well. But all through 2009, 10, 11, 12, 13, 14, 15, 16, 17, we were way higher than 4.2%. Now, if we zoom in, devil's advocate says, well, the trend is up. It was up, and it seems to have flattened out. If we stay here and we keep our unemployment numbers at 4.2%, that's going to be great. However, the table here is saying how's unemployment going to factor into a 10% rise for the S&P 500? Well, again, this is my opinion, maybe not yours. My opinion is, for now, good. Wait 6 months. I think that this is the big wild card here. Inflation, it feels like we've kind of got a slight grip on that one. With all the layoffs from Doge and other companies, Wadle, I can't even spell, and other companies making layoffs, we've heard a lot about other companies making layoffs, this could have a big impact on the big picture for the unemployment numbers. So and you guys are right. I see Luis saying AI will change this. Absolutely. I absolutely am a big believer that AI is going to steal jobs. It's going to transition people into other areas of employment which may not pay as well. AI is amazing, and learn how to use it to make your job better or find yourself a new job where it's somewhat proof from AI. But I think in 6 months we'll see that number drift up. Therefore, well, let's wait on my decisions here about the Fed. So far I've got one piece that would support big upside movement, and in my opinion that's inflation. The second piece here would be unemployment, which it looks great now, but Big Eb says we need a lot of people in the trades. Absolutely, bring them back. But a lot of people don't want to do trades. That's physical labor, Big Eb. We got to clean toilets and hang sheetrock and do that type of stuff and do electrical work. People don't want to do that. Oliver, yep, exactly. Oliver, I think Larry or who was it? It might have been Don who was talking about, I think it was Spotify, said that if your job can be replaced with AI, they're not hiring for those positions anymore. Makes it easy. Trades are hurting, especially HVAC. Yeah, you never go wrong with a trade. Well, for now, trades are a great place to be. Cybersecurity, but pretty soon, Oliver, your cybersecurity will be an AI bot, an AI agent that evaluates all of your systems and says, here's your vulnerabilities, here, fix them, and then hire the robot to fix it. So even I think cybersecurity could be beaten with AI. All right. Exactly, Fluey. Not when you get a robot to do it. I own a construction company. There has been a trade labor shortage for 20 years because people want the not lazy jobs. Let me rephrase that. People want the jobs that are less impactful on their body, right? Look, I work construction and I loved it. I was probably in the best shape of my life when I was working construction. And actually, I did grocery stores when I was younger. I was the guy who stocked all the groceries. That's manual physical labor, moving all the boxes and carrying everything around the store. I was in great shape. And then you get a desk job where you're sitting and you just get fat and, the waistline continues to grow the longer I sit in these seats. Anyway, I'm not going to get through all this if I keep talking. So let's talk about tariffs. With tariffs, this is a real tricky one. I guess it boils down to two factors. Number one is, how long do you think that this is going to go on, this back and forth push and shove with major powers around the world? And then number two would be, when we finally do come to an agreement, which I do believe we will, I think we will come to an agreement with all the countries out there, how bad do they impact the bottom line for companies, right? When you've got things like Trump going after Apple and saying, if you bring back your factories or bring your factories back to the United States, or, you're getting 25% tariffs right away on your goods, that's problematic. So I think I look at the tariff issue as, honestly, it's a good thing if we get it resolved. Until it's resolved, I'm not sure I see the markets moving up 10%. If we see China fall and Europe fall, and when I say fall, I mean come to an agreement, then I think that we have all-time highs coming. So let's go. I don't know what to put for the tariff side of things. It's really, really difficult to put this one. If resolved, I think you're talking 20% higher, depending on what it is. Once we get that off the books, man, it's like the biggest factor, in my opinion, that's stopping these markets from ripping. Everything else seems pretty good right now. I gotta be careful with my comments because I don't want to get people upset. Some people think I hate Trump. Some people think I'm a Trumper. I'm neither. I'm middle of the road. I'm really what's best for America. That's all I really want. China is a big one, in my opinion, 100%, Steven. We all know that, right? That is, without a doubt, the biggest one. And they can play economic hardball with us longer than anybody else. So if that's resolved, I think if we sign some deal, regardless of what the terms are, I think you're going to see a huge update for the markets. Huge. In Trump's homage to Trump, it's going to be huge. No one's seen a day like this. It's huge. 20% upside. I know 20%. I make 20% every day. It's what I do. All right, so I've got two factors there. I've got the inflation. I think that supports more upside movement. I think inflation for now is much tamer than what it was. Even though it may not be totally under control, it's way better. Unemployment looking great, but I'm still concerned with AI and all the layoffs that have happened and may be coming. Tariffs, painful, but if it does get resolved, I think 10% would be a low end. I think you could see a 20% higher if it gets resolved. And to play devil's advocate here, the longer this drones on, the more it'll start to impact the markets. But I really don't think it's going to drone on that much longer, right? Yep, Andy, I agree. As long as big players sign the trade deal, markets will take off, right? And I think we all know it's not going to be 100% tariff on China. It won't be that extreme, right? It's just going to be a number that we say, okay, this is going to be a tariff. Since you've been charging us, here's what you're charging, we're charging. We're all right with that. And hopefully we come to some amicable agreement. It's going to happen one way or the other, in my opinion. Spending bill. Oh, I had a graphic set up for a spending bill. Unfortunately, it did not come through. It was a picture of a pig standing in front of the Capitol Hill. I don't know if you guys saw what Elon Musk tweeted out today. This is why I like Elon Musk. He has a DGAF attitude. He just doesn't care. He says what he really means, and he has no issues about hiding his opinions. It seemed like he was the right-hand man of Trump, right, with this big, beautiful spending bill. Well, his comment today, I actually took it from his Twitter page. He wrote, and I quote, "I'm sorry, but I just can't stand it anymore." Right? This is today at 10:30 in the morning. "This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those of you who voted for it. You know you did wrong. You know it." Oh, man. You know that I would love to have been a fly on the wall in Trump's office when one of his staffers walked in and said, "President Trump, I need you to read this real quick." Oh, you know that he fumed. He probably turned beet red because he needs Musk on his side as much as possible. And now Musk just completely screwed over this bill by making these statements. So this does not help. Elon said it takes more effort to clean up the government than to get to Mars. I agree with that. I think that we've got Democrats, we've got Republicans in this chat as well. You'll all point at the system overall, not just your party, but the system overall is messed up. It's completely messed up. We'll never fix it. And in looking through some of this bill, I tend to agree with it. I haven't looked through the whole thing. I'm sure Elon has way better knowledge of what's in it than I do. But what I'm hearing is more and more stuff is shoved into there, and they're pressuring them to vote for it so that they can get a lot of stuff passed, as always happens, right? It always happens. Anyway, this is not good when we look at that fourth component, which is the spending bill. Now, at some point, we're going to have to get some spending bill. Otherwise, this debt ceiling is not going to get moved again, and it starts to create more issues about government shutdowns, which leads to layoffs and more uncertainty. But we'll come to some agreement. It'll just be months of bickering. Oh, that would be that's good, VB. It would be great. So VB says, just ask Grok what's good and bad in it. It would be even better if you could say, hey, Grok, create the perfect spending bill to get our government back on track. Like, let's see if AI prints that. And it probably won't be 1,500 pages or however long this damn thing is. It'll be like a 10-page document of just, here's what we need to do to get back on track. Let's have Grok do it. Steve said, I just seen the world deficits at 3 times more than the world total GDP. Well, look, we've said it on this program since I've been doing it here. We've been saying it on Power Trading Radio ever since I started that back in 2010. So it's been 15 years of a consistent theme from not only myself, but from John O'Donnell, which is if we continue to spend like this, we're going into bankruptcy. There is no doubt about it. No doubt about it. In order to stave off bankruptcy, they will print more money to pay their obligations, which devalues your U.S. dollar, which makes your purchasing power go down and weakens your purchasing power. All in an attempt to save them from the problem that they have created. So, we should all rise up, regardless of which party you believe in, and say, hey, you got to fix this spending. Stop, right? We voted you in office. Whether you're Democrat or Republican, we voted you in office to fix this, and you finally get there and you haven't done a damn thing. Same for every administration in all of my life. I think Clinton might have done good because we had a budget surplus back then, but I wasn't fully involved with politics back then, so it is what it is. So the spending bill. I think that this is a negative piece for the market right now, but not a major one, right? I do think that it's a major thing for the economy overall, but I don't think it's a piece that's going to stop necessarily the market from moving higher or lower. It might minimally impact, in my opinion, what the trajectory of the market is. Obviously, spending is a key part of this, and what gets pushed through and what doesn't will have a factor. But I'm going to actually, for now, I'm going to say a negative impact, but minor. Negative, but minor. And that's just my opinion. I know I'm going to get a whole bunch of comments here. I'm like, no, this is really important. I think that the spending bill is the numbers in it are bad for the economy. They'll create more deficit. But spending does keep things moving to the upside. Always says, I understand to save, but sometimes we are debt so much we might spend our way up. I don't think that's going to happen. I don't think we'd spend our way out of debt. You put yourself in more debt. Put yourself in more debt. What did Margaret say here? Bush raised taxes and we went into a recession. Oh. Well, I don't think anyone's done a perfect job as long as I know. No matter who's in office or which administration is there, there'll be some good things that come out of it and some bad things. It really feels like if we had a more unified front and less bickering between political parties, we might be able to get some real headways made here. But, we have this two-party system. Unfortunately, when I lived in Italy, there were like 7 different parties on the ballot, and they were all fairly even with regards to, potentially being in power. And I think that makes things a little bit better. We have this really wicked two-party system that I'm not a big fan of. The spending bill will create more inflation. It certainly could. Depending on where that money gets spent and how it is, yes. Amount says, biggest issue with the spending bill is it only addresses discretionary spending. That way they only need 50% plus 1 to pass it. Ugh. Well, I'm going to keep that as a negative, and I think that part of the negative here now would also go towards what you're talking about, because you spend more, you do impact inflation, right? Now inflation seems to be a little bit better. It really depends on where that money goes. How does that spending get allocated? There are certain things that will get cut. There are certain things that are going to get spent. I would like to see Doge do more. I'd like to see more cleanup from Doge and find wasted money and put that back into our expenses. And hopefully that will bring us down a little bit more. But there's a lot of people that just think Doge is just pure evil. Certainly they might be going a little too far, but Doge, there needs to be an agency that goes and checks out spending. the reckless spending. Next, trade war. Well, that kind of ties into tariffs here a little bit. But again, the longer that this goes on, the worse it becomes. So I'm kind of lumping these two together. When I initially put it down, I thought they're slightly different. Tariffs is obviously the amounts that we're charging, but you might be doing other things with trade wars. For example, the CHIPS Act saying, oh, well, you can't send these chips to there, or, China can't get our H20 chips from NVIDIA, and that hurts NVIDIA. So I kind of have that as a different one. As a different category here. And right now, I would argue, I'm going neutral here. Because they've wanting to repeal some of that CHIPS Act, allowing a more open border trade. I think that's going to be better, but there are some things that are bad with the trade war going on. We'll leave it there. Now the tough one. And by the way, somebody asked me about yield curves. I don't know if you've seen this recently, but if you go to TradingView, they got a really cool feature now with yield curves. So you click on this little icon on the side, and you can see all the yields. You see the different maturities here, which is fantastic. You can, take whichever ones you want. So this is June, as of today, this year, and of today, last year. You can see in the dark blue, that is current. We've seen such a huge shift in the short end of that yield curve and the long end starting to tick back up. So it feels like we're getting back to normal, but boy, what a huge discrepancy between your 1 month and your 2 year. Actually, your 3 year. I mean, it's just really low. Right now, your 3 year is getting you 3.88%, but you can get in a 1 month and get 4.3%. Pretty crazy. But so a very nice feature they just added here. TradingView adding more and more features there. Would banning certain Chinese brands come under trade war? Yes, absolutely. You mean like if we said Huawei, you can't use Huawei chips in the United States? Absolutely, that's trade war, right? Because now you're saying the trade that China wants to do with the United States, we're now censoring that or putting limitations on it. That absolutely would escalate. And if the president goes forward and says, hey, Huawei chips, which some argue is a big competitor to NVIDIA, we can't use those in America, right? If Trump says you can't use Huawei in the United States, we're banning all Huawei chips in America, China will retaliate right away. And they will start saying, well, you can't, we're not going to allow any of this. No Apple products, no Tesla, whatever. They'll start hitting us with some of our major economic driver companies. So that's what I meant by trade war. Yeah, absolutely. Perfect. Is the United States self-sustained? I think so. We are self-sustainable. However, there were certain things that if we were to cut ourselves off from China, from Vietnam and Thailand and Mexico and Brazil, there are a lot of things that you and I enjoy day to day and take for granted that would be significantly higher. I mean, we are talking massively higher. Can you guys imagine what would happen to the price of coffee in America if we just said to Central America or South America, we want nothing to do with you? You guys aren't part of our trade thing. We're going to be self-sufficient here. There's only one state in the United States that produces coffee. So Starbucks, done. Business over. Because no one's going to be paying $80 for an iced mocha. Right? There's no way it would happen. There's no way. So in many cases, we are self-sustainable. But, if we had this discussion the other day, and a lot of you sent in some good numbers. I don't know the actual numbers, but if you have, iPhones manufactured in the United States, exclusively with no parts from Indonesia, India, China, wherever, that phone's really, really expensive. I mean, we would probably not want to use cell phones for the cost to be so prohibitive. Now, if you're talking about energy, yeah, we're energy independent. We can definitely do with our own energy. We're fine there. Textiles. I would argue we could probably be fine with textiles and clothing, but the cost would go up because of the manufacturing process is much higher here in the United States. So, yeah, we could make the statement known that the United States is self-sustainable. But in being fully self-sufficient and cutting off all the world, a lot of stuff would be very, 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 very expensive. War manufacturing needs to be brought back. You should ask Juan Valdez about expense. Oh, that's good. That's good. Well, it's funny. Most people don't know that only one state in the United States produces coffee. I found that fascinating. Great trivia question. One state. You kind of we hear about corn and wheat and soybeans and cotton and, and not much chocolate going on in America. Can you imagine how much a Hershey's Kiss would cost you? Rather just buy a diamond ring than a Hershey's Kiss. There you go, Andy. You're right. Hawaii. So let me go into the long-term interest rates here. That's the first one. This is real difficult. If right now the trend, in my opinion, and this is just my opinion, is that the probability of the U.S. defaulting is slim. However, being downgraded by Moody's, and we already had Fitch a couple years back, and we had S&P a few years before that, having the U.S. debt downgraded was a bad sign. And I believe the last one was a keep up with the Joneses, kind of a nothing burger. If we get a second downgrade from, let's say, S&P or Fitch, which were the first ones to downgrade us, this is really bad, and that will cause yields to spike. If the financial health of America continues to decline and our debt to GDP ratio continues to soar as it has been, then those yields for long-term dated bonds, talking 10, 20, and 30, will continue to move higher and higher and higher. The higher those go, the worse it is for the United States. Now, we could go and look at the 10-year yield right now because that's what I usually reference. Here's your yield on it. Conveniently, we came right down to this trend line, which I connected with 2 points going back to the low from April 4th of this year, and we're now making higher lows. The big challenge for us right now would be, do we get above this high from May 22nd? The high on May 22nd was 4.62%. We're only at 4.45 right now, but we've got to get above that high. If we get above that high, then I think we kind of are in trouble. I think we're definitely looking at rising bond yields. You also have other factors here which could cause that 10-year bond to rally more. Now, for those of you who are new, if you are new, hit the like and subscribe button and share it. I always love to get more followers and more people watching this program and more input. But if the 10-year is how the government is raising money to pay for its debt, right? We put ourselves in these bad financial situations. We are inefficient with our money management on a government level. We make very bad decisions for the most part. Therefore, we have more and more and more and more debt. They sell bonds to raise money to pay the interest on that debt. So the lower those yields, the better. We'd love to see these yields back to what they were back here in 2020. Oops. Back down around 0.6. Yeah, we love that. I mean, we're almost 4% higher today paying back our debt than we were back in 2020. Now, the other factor here, which I think we've talked about a bit, but it needs to be talked about more, is the move away from the dollar. The actions that have happened over the past few months have caused international countries to look at America and not like us so much. Now, you may not feel that. You guys are all living here in America, and behind our borders, it seems like, it's fine, whatever, this, that, the other thing. I lived in Europe for a long time, and I have a lot of friends in Europe that are like, what the hell's wrong with you guys, you stupid America? I mean, these are close friends. Like, what is wrong with America? The mood is like shifting towards American hatred. And if that persists, that means people will move away from U.S. dollar-denominated assets, and that could lead to less buying of that debt. Remember, we talked about the U.S. dollar being the world reserve currency. If we lose that status, then they'll be holding other currencies instead of the dollar. Now, I don't think we'll lose it. I think it'll start to diminish its power a little bit. But if Saudi Arabia opens their door to any currency to pay for oil, which Bill Addis has talked about, John Rowland has talked about as well. It used to be you had to buy oil with dollars from Saudi Arabia. If you're Saudi Arabia, don't tell me what I have to accept for my oil. Why can't I accept rupees or dinar or lira? And now, crypto payments. So if you're Saudi Arabia, you are kind of the gateway, in my opinion, to a weakening of the dollar. The more that they open up those borders to trade with non-dollar denominated assets, the less dollars people hold, meaning the less bonds people will buy from the government. And that could cause these yields to spike, particularly if you piss off China and they start selling their portfolio of bonds, and Japan or other countries start selling. So I look at long-term interest rates as actually a negative factor. This will hurt growth because, in my opinion, those long-term interest rates are going up. I'm just going to add on my graphic here. Going up. Now, using dollars could be a negotiation tool with the tariffs. Yes, it certainly could be. I think it seems like more countries are going, hey, we want to pay with what we want to pay with. And that could continue to slowly erode the power of the U.S. dollar. And now you have the short-term interest rates. And that leads us back to, the rate announcement happening on the 18th and the chart we've looked at many times, which is the Fed funds futures, and looking at what the probability is for short-term rates. That's really where we see it, right? This is the short end machine right here is what's the Fed going to do? Right now, there's a 98% probability that the meeting on the 18th, those rates stay the same. A few months ago, we had a prognosis by one of my favorite people, Bill Addis. And he thought by the end of this year that they might actually raise interest rates, not lower. And I agreed with him under two conditions. Number one, that trend we saw on core PCE price index continued to move higher, and that we'd start to see unemployment numbers surge because the trend was to the upside. Both of those have changed direction. So I don't think, at least for now, that we're going to see a rate hike by the end of the year. And I do believe that probably in September, if it's not July, it's going to be September, we'll see a 25 basis point cut. So I see short-term rates going lower as long as those factors we talked about earlier, which is the inflation numbers and unemployment numbers, those stay relatively close to where they're at. I see these going down, and that would positive for growth. Sorry, I can't even spell today. Typing GRWTH, and then I'll just have this autocorrect. So real quick, let me just get your take on it. These are kind of the big factors here that I see, which is inflation, unemployment, tariffs, which is the actual percentage of tariff, spending bill, which is getting some negative press, trade war, meaning are we doing, you can't buy this, or we can't buy those, or you can't bring this in our country, that type of stuff. I have long-term interest rates, short-term interest rates. What else am I missing, guys? From as a team analysis effort here, what are we missing, which would be factors for this market moving up 20%? You could say supply and demand, but these are the factors that are driving supply and demand. We've got interest rates, the strategic reserve, but of what? Strategic reserve of what? The failing bond auctions, well, that would be your short-term and long-term interest rates, right? That would be impacting those two variables there. Relationship with trade partners, yeah. And Tofi, I lumped that into the trade war and tariffs. I don't think that the strategic reserve of gold or Bitcoin is necessarily an economic driver, right? By holding gold, what it does is it gives people the confidence that the U.S. government actually has some tangible asset to back up some of this debt. Certainly not all of it. But again, we heard so much. I mean, do you guys remember beginning of this year? How many people were talking about Trump was going, we're going down to Fort Knox, we're going to audit that Federal Reserve. Elon Musk was going to go with him. Did you guys hear anything about that? Did we audit gold? Was there anything that, I think what happened is they went to Fort Knox and opened those doors and there wasn't jack there and they were like, oh, we're not telling the American people that. Are you crazy? We are not saying a word. That disappeared like that. That was such a headline grabbing piece. Social media was all about gold, Fort Knox. And I'm like, let's do it. I want to see the cameras. And there was nothing. No, I haven't heard a follow-up or article, story, interview, comment about that since, what was it, mid-February? Crazy. Exactly, Margaret. Don't open that door. Oh, man. I would have loved I want to see, it reminds me of Geraldo Rivera. I'm showing my age here. Some of you might remember this. But Geraldo Rivera did a thing where it was the opening of Al Capone's vaults. And, you're so hyped up. It was week after week after week of, they were just pushing this program. I was so excited as a kid. I was like, man, Al Capone's vaults. We're going to have guns and bodies and drugs and weapons. I mean, I want to see what's in this thing. You guys remember what was in it? Anybody remember that? They did it live on Geraldo Rivera. It's probably widely watched. And the most valuable thing in there was an old Coke soda bottle. It was all trash. It was garbage. It was so funny. I think that's what Fort Knox is. I think Fort Knox is just, there's no way they can have all the gold they say they have. Yeah, crazy. Anyway, I thought that was kind of interesting that was such a headline story on, how Trump was going to embarrass the Democrats for, saying they have all this gold, and he probably opened those doors yeah, I can't tell them there's nothing there. The fridge is empty, man. I got a dinner party and the fridge is empty. I'm calling DoorDash. Yep, 90-minute program on prime time and every channel or there was so much hype on that. Oh, it was great. Okay, so let me wrap this up because I have other things I want to talk about. As far as those factors go, driving this market, if we keep things right where it's at today, I do believe we'll break all-time highs. I do believe we'll be 10% higher from here. If we get some shock factor, and in my opinion, the real shock factor is going to either happen from prolonged, insultive tariff wars, but I think that is already done, meaning the initial jabs, right? Like in the art of the deal or his typical negotiation tactics is you throw out a number that's so ridiculous. You know, I'm selling some stuff on online, and I want $100 for this thing. The guy messages me and he goes, "Will you take $5 for it?" And I just said, "Kiss my ass." $5 for a $100 item, beat it. That's Trump's approach here, right? Shock him with a number that's so appalling and then backpedal back. I think the initial numbers have already been thrown out there. We're going to find our way back down to kind of a happy medium here. And because of that, I think the initial shock factor is gone. Now we know it's on the path to getting done. Trump says it's going to happen here anytime. That leads me to be a bit more optimistic and positive here. So keep going. This market trend right now, if we go to the S&P 500, we had a nice 0.58% jump today. In my opinion, the real big obstacle here is going to be that 6,000 mark. All right, we've already hit it a few times. We hit it back on May 19th, hit it back on May 20th. We hit it again. We just tiptoed across it on the 29th of May, and now feels like we're rallying back up there. So this looks pretty good. Big Eb says we're only 3% away. Yep, something like that. Yeah, I think we'll be an all-time high, sure. But I do think we'll be, from this point, 10%, I think could be very, 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 very possible target. And if any one of these things switches, it could change that, obviously. If inflation starts to surge again, then, okay, well, no. And it's hard because this is a moving target, right? You're asking me about a destination and I'm on a moving train, but between here and the destination of this train are hundreds of switches where that train could go down a totally different track, which is why we trade, right? To kind of see what those transitions are, see what the trends are, stay with the trend. At this moment, hard to argue this trend, at least what we have since early April, which is higher highs, higher lows on the broad market indexes like the S&P. You look at the NASDAQ, you've got an even better picture because today we closed above that high point, right? That's the same relative shape as the S&P that's on the NASDAQ, but the NASDAQ has actually broken those highs. So to me, NASDAQ is now searching for those high points that we see from back in February, which would be about right around 22,225. After that, I think you're at all-time highs again. The Magnificent Seven, not all of them are doing great. I'm going to talk tomorrow about Google. I'm bearish on Google, and I'll explain why. You had Meta, which, Meta was an interesting thing today. Meta had a nuclear deal with Constellation Energy. I don't know if you guys saw that. A 20-year deal with Constellation Energy to bolster nuclear energy production, of which they get a good deal on because Meta is building out big data farms. And the trend is your friend. What's the trend? The trend is AI. How are they going to do more AI? They're going to build massive data centers. How are they going to power those data centers? Energy. And there's not enough there right now to do that. So, we talked about this when I did the Going Nuclear show last year sometime. A lot of those are starting to look even better and better and better. I know some of you guys are holding on to your nuclear stock, so awesome. CEG, I think, is Constellation. Constellation today, it's funny because you look what happened there today. Big Ebs, I love that you typed that in, Big Eb. It says, did not do Constellation price any good. Buy the rumor, sell the news. You think that this was brand new to the insiders? This has been a deal they've been working on for weeks, if not months. And notice what's happened since April. I mean, it's rallied to last night, 94%. And then they make that announcement and it erased all those gains. That's a buy the rumor, sell the news. Plus, it rallied right up in overhead supply. So there's definitely factors there. How the Magnificent Seven's going nuclear. That'd be an interesting topic. They're all going nuclear, right? They all need data. They all need it fast. It is the fastest data possible. And they're all going to integrate AI, which needs even more. That deal does not pay them market price for the power. Right, it's subpar. I didn't see the deal specific, but it's lower, right? They're basically investing in the company, and as far as growth, they're getting cheaper energy costs for it. What else did I have on here that I wanted to get to? Genius Act. I listened to an interview with Senator Loomis. You guys might know Senator Loomis. She is, I believe, Wyoming, and she is very sharp. She knows a lot about crypto, and I'm pretty impressed with her knowledge of crypto and how Bitcoin functions, things like that. She was talking about the Genius Act, which of course regulates stablecoins, and she said, we're going to push this through next week. And I don't believe that's going to happen. But if this Genius Act does go through next week, then my friends who are in crypto are going to have a phenomenal week. We are going to see big moves to the upside because that fosters more adoption. That will be good for things like Bitcoin, which has been not struggling. It's been stair-stepping up. We talked about it when it started to pull back here. We talked about coming back down to this demand zone, which is between 102 and 103.5. Man, we came down to it on Saturday. We came down to a low price of 103, 127, just barely into that demand zone. Now we're rallying up a little bit. If that Genius Act gets passed, guys, this thing is absolutely going to scream to the upside, at least move to the upside. Now, before I wrap up here, let me tell you about another trade today. It's kind of funny. I'd rather share my losing trades with you guys than my winning trades, because winning trades, I just did what I'm supposed to do. And I had, in two of my accounts, phenomenal day, but it just did what I was supposed to do. I wanted to show you this trade again today. You guys remember yesterday, I talked about picking an open range breakout, making a trade off that using an ATR and having the stop loss just greater than the ATR. Today was almost an exact repeat. Literally the same loss. Here's what happened. I'll throw a 5-minute chart here. It was kind of funny. And I love that I told you guys yesterday, I'm going to do the exact same thing next time. Well, so here is the green line here represents the high of the opening 15 minutes, right? So here's when the market's open at 6:30, you had 5, 10, 15. So I put a line across that high and said, hey, if we get above 59.52 on the S&P, then that's my entry point. So you can see it right here. It tiptoed above it. It just barely tiptoed above it. It got to 59.53.5, so almost a full point above the level. And then as soon as it filled me, it proceeded to fall. Now, I used a 7-point stop. Well, it fell 15 points. It stopped me out, and then look what it did the rest of the day. This is why trading drives people absolutely mad, right? Absolutely mad. The longest candle of the day happened right as I got filled long, and it shot down, and literally, it's almost like they were listening to the show and like, hey, you know Merlin did that trade yesterday? He's in that same trade again today. Let's mess with his head. Let's take that thing down. It was funny. Anyway, I just wanted to share that one with you because it's one of those things that just frustrates the hell out of you. And especially when you look back at the end of the day, where I got stopped out for a 7-point loss, but, at some point, I would have, there's no 7-point pullback here. I would have stayed in this trade all the way up to, I can show you the 7-point pullback here. 7 points would be lower than that. To there. This is where I would have been out. That would have been an extra, I know, shoulda, coulda, woulda, right? Shoulda, coulda, woulda. I know, don't shoot the messenger. But that would have been a 45-point winner versus a 7-point loser. Cracked me up. My entry was like at 7 in the morning, Pacific time. It was pretty funny. I know it happens all. That's why I'm sharing. Big app. I'm just sharing because it's commiserating, but it's also, am I upset about it? Am I going to sit here and lose sleep over it? Oh, no way. I just thought it was funny. And because the same thing happened yesterday. I don't use OTA, Trading Academy's rules. Well, for the most part, I do. You should have waited for that candle to close. Yeah, I'm up on. See, that's the thing. You could do on break or on close, and I did on break, which is typically what I do. Yeah, thanks, Luis. At least you're consistent. No, I don't do the close of the candle. Not on an intraday trade. If I'm doing a longer term swing on a daily, I like to wait for the dailies to close, but intraday I don't. Yep, Oliver says opening range breakout is king for me, though. Yeah, I love opening range breakout. It keeps things really, really simple. All right, let me real quickly go through the top 5 or top 8, just so I can wrap this one up for you guys, and then we'll convene for the day. Gold, obviously, because we had such nice moves up in the broader markets, that was a risk-on type of moment, which means gold suffering. We were down 0.59% for gold. However, let's go back to there. The trend here is starting to look a little bit better. It's no longer kind of feel like it was making lower highs. We'll see if we can get back up to that 34.40 mark here. Looks good. Yeah, I know, Chris. I know. The 10-year yield we already looked at. I love the way it hit this trend line and is actually sticking right on it. So I expect that trend to continue, meaning higher 10-year yields. Dollar index, it bounced a little bit. I still am a believer that we're going to end up down in this demand zone between 97.70 and 98.30. That's that yellow box I have drawn on the screen there, which just seems really logical as a target here. I'm bearish on the dollar. I think you're short in dollar rallies going forward until the trend changes. S&P was up 0.58%. We already looked at that one. Beautiful intraday run, except for the time it stopped me out. That will happen. Your NASDAQ was slightly better at 0.8%. What makes this a better chart is we broke above that high from just back in mid-May, which is great. That tells me, or at least it leads me to believe, that we are going to be moving higher on the NASDAQ. Of course, tech going to be the big driver there. Top 3 was crude oil, 1.42%. We now have an inverted head and shoulders. The question is, do we break? This is going to be a very interesting period of time between this neckline on the inverted head and shoulders and the trend line, right? We've got a short-term trend showing strength, and we've got a intermediate-term trend showing weakness. One of them is going to give. One of them will be respected, right? Russell 2000, 1.58% gain today, rallying right back up into that overhead supply. Keep in mind, the S&P is still stalling at this overhead supply. NASDAQ is through it. Russell is in it right now. And your leader for the day, Bitcoin, 1.76%, still respecting that demand zone in that 102.5 area. I think that we'll probably see this stabilize and start moving to the upside here as more positive news comes in about crypto and digital assets. And that, my friends, is your show for today. Karen, thank you for the question about the market going up another 10%. I do believe so. I think at this point, the trend is your friend. You guys know earlier this year, I was definitely much more bearish on it, and now things are starting to change. And I have the right to change my opinion and make my trades accordingly. Right now, I do have a bunch of long positions, which those hopefully expire on Friday. I'm just selling covered calls against long positions and opening up, selling some put positions as well. Watch for the higher low to hold. Yep. Exactly. And that's what we're watching for here on Bitcoin and all these broader markets, is saying, want to make sure that level there holds. If it does, then we are moving on up. Big Ed says, good to see you on the bullish train. I change all the time, Big Ed, but yeah, right now, definitely on the bullish train, and it's been a great 2025 has been a great year so far. Let's hope we end it strong. So, guys, if you have any comments, questions, feedback, things you want to know, email me. Send them on in at tradermerlin@gmail.com. It's on the screen. Put them down below, any YouTube videos as well. If you guys are new, hit the like, subscribe button. I always appreciate that. Thank you guys for enlightening me today on my opinions, which may not always be right, but at least I got some passion behind them. I will see you guys tomorrow. Take care.